Okay.
Muted.
Thank you for coming to see this lecture, this webinar. I'm going to talk about yield structure and how to view it in 3D. So this is going to be a longitudinal study in modeling yield structure in 3D. Now, for the ones that don't know me, this is some of the stuff that I do. I'm an author, a lecturer, a proprietary trader, and I am very, very close on getting my dissertation done. So I've written about complexity science, behavioral finance, dynamic hedging, financial statistics, and I come from a theoretical framework using chaos theory. I talk about economics and finance, proprietary trader in currency and the energy market, and my dissertation is hedging the currency and oil futures market using something called seeding horizontal control and stochastic programming. Some of the things that I've written is chaos theory and economic emergence, which is about chaos theory and fundamental economics. It talks about agent-based modeling using complexity science and behavioral finance. Black Box, the alchemy of finance, is talking about research methods and statistical methods within the quant world. Escape Velocity, A Quant's Journey to Hell, is about corporate finance, mergers and acquisitions, and risk management. The risk management is dealing with dynamic hedging. You can reach me at the studio, Reykjavik.com here, or you can sign up and follow me on Twitter. That's my Twitter handle. And you can find me on YouTube, and please subscribe. The other things that I've been working on are some books and some software that I've been developing, and you'll see a little bit of it tonight. The next book that I'll be publishing is something called Surface Volatility of Volatility. And I typed, oh, this was a typo. It's going to come out in 2014, not 2104. And it's going to be part of my dissertation when I get done with it. And it's also going to integrate some of the graphing that I've been doing at Poseidon. The next book after that, it's going to be published probably early 2015, is what I call Market Armor. Most of my research has been, and publications have been at the PhD level. I wanted to write a book that was a little bit more accessible to people that may not have a PhD, but were interested in trading, and a little bit more of the philosophical aspects of it, and some of the new things that are coming out in academia. So I wrote this, I'm writing this book, and I'm blogging about the book also as I write it. It's going to be about chaos theory, complexity science, and what I call topographical finance. Then I've been doing some research in artificial intelligence and virtual reality, which I'm going to be writing a book, which will be at a graduate level, PhD level, dealing with what is called artificial general intelligence. I'm primarily going to be focusing on what is called OpenCog, which is an open source language for general intelligence, and the new visualizations for finance and relative to virtual reality. All right, so that's what I've been doing. And let's go to the meat of this lecture here. What is a yield curve? Well, the yield curve is basically a curve that's measured in time in the x-axis and the actual interest rate, or what's called the yield, in the y-axis. And it shows, typically if you're looking at it from a U.S. perspective, the U.S. Treasuries, from 1 month through 30 years. And the yield curve is not, even though it looks continuous, because the maturities are discrete, it's not really a continuous curve, and the gaps between the maturities are interpolated. What that basically means is that the maturity between the 20-year and the 30-year, there is no such thing as a 25-year bond. So it's linear, at least in this picture, it's linearly interpolated between the 20 and 30, and like so for all the other points. So not all maturities are available in the yield curve, so there is some assumptions that are made between them, but linear interpolation is a close approximation. Now, there are many different types of yield curves. There is the normal yield curve, where it is shown on the left here, where the actual low maturities have a lower interest rate than the farther out maturities, like the 30-year. So it's positively sloped. There are other shapes that are possible. You could also have a positively sloped normal yield curve that is shaped this way instead of this way. So there's changes in the actual shape or convexity of the yield structure. Now the yield maturity for the inverted, that's a little bit different animal. That's the opposite of what a normal yield curve is, where the front of the yield curve has much higher interest rates than the lower, farther out of the yield curve. This is usually a sign of a recession, where there's economic turmoil. This is usually a sign of economic prosperity. Now, it's possible to have a flat yield curve where the early maturities are roughly the same interest rate as the far out maturities, which is odd because when you do discounting cash flows, it doesn't seem to match normal thinking in terms of if you're going to loan out money for 30 years, it should be at a higher interest rate or a higher discount factor, which is the yield, than if you were going to only loan it out for 30 days. So this is a very odd scenario here. But you'll see in some of the 3D charts that I show that it's actually more common than you would think. Then it's possible to have what is called a humped type curve, where in between maturities may actually be at a higher interest rate than the front of the curve or the end of the curve. And that could be, it's usually considered the belly of the curve. So the 5-year treasury could actually, in theory, have higher interest rates than the 1-month treasury or the 30-year treasury. Now, the problems with yield curves. The yield curve is only a cross-sectional analysis in respect to a particular time frame. So going back to this example, this is only showing the different maturities and its interest rate at a specific point in time. That's what is considered a cross-sectional study. But the longitudinal study is throughout many different times. So in this case, if I zoom in here, in this case, I'm showing yield curve. These are surfaces that have been produced out of Poseidon. Now, the yield is in the Z. The time starts here and moves this way. So this is actually the way I rotated this. It's maybe not, it's kind of counterintuitive, but the zero time is here. So this is the what I consider the longitudinal study here. So in this case, it's 47 days of data. This day 1 all the way to day 47 here. And then this zero line for maturity in this axis is the 1-month maturity all the way to the 30-year. So you can see that we were actually at the very beginning of time, which is, I believe, July 2001 is my data set to 2008, 2014 in my total data set. But this is only showing the first 47 days, just to give you an idea. Now, you can see here that we have a positively sloped yield curve. all throughout the longitudinal study, but it does change over time. The actual shape of the curve changes. Yields in the front of the curve actually started dropping at around the 32-day mark. So what's the power of seeing this in 3D is you'll get to understand things in terms of time and how the structure is dynamic. Now, so you need that for analysis of if you trade the bond market or even use it as telemetry. I don't trade the bond market, but I do look at the 10-year as an important indicator. But as I get farther along in this and start rotating the surfaces for you, they'll give you some ideas on how to use it in trading. Now, here is a study where it's the same data set, but instead of 47 days, it's 519 days, I believe. And here again is the 0 point per time, all the way going up to 519 days, the yield, and the different maturities from the curve all the way to the 30-year. So you can see the 30-year being much higher than the 1 month. But again, you can see that there are undulations here in the market that could be traded. Now what I'm going to do is I'm going to show the graphs in 3D for you. And how do I do that? Okay. Now, so again, this is through Poseidon. These surfaces are much different than the volatility surfaces that I've done in the other webinars. It's a different type of parameterization. Actually, doing this yield surfacing method is pretty simple compared to the other surfaces that I created. So if someone could even do this in Excel if they wanted to, but what's going to happen in Poseidon is I'm going to be able to give certain menu options when I release it in production for the commercial product, where you could actually pick a particular time and look at and extract a particular curve from whatever surface you have, not only based on a particular time, but you could also slice it based on particular maturity through time. So you could slice this in different ways, and you could also do spreads, spread charting, where you would look at the spread and over time how it's changing between, let's say, the 10-year relative to, let's say, this 6-month maturity. You know how that spread is changing. But you can see here that the spread between the 30-year and the 1 month is changing. And so because that's changing at a much faster rate than the 30-year, that this 1 month is changing at a faster rate than the 30-year, there's trading opportunities when this happens. So this is pretty over these days here, for the last 25 days in this data set, it was pretty static, so there wasn't much money that could be made. But then after that 30-day mark, bam, the spread between the 1 month and the 30, you can make some money doing a spread trade. Whereby, because this yield went down for the 1 month, that means that the bond, that treasury, its price is appreciating. So you could have long that position if you were going to do a spread trade. You could have long this position here, and you could have shorted in the futures market the 30, and you would have made some money. Yeah, I'm sorry. Hold on. It's over.
Which you should see appear in just a moment. The question is,
hang on. Okay, I'm not sure if someone is. Okay. So again, you can make money by looking at these types of surfaces. You could do a spread trade. You can go and just say, okay, I'm going to go in the futures market and buy the future for a particular maturity and either go long or short based on the moving dynamics of the system here. So this is, you know, the power of looking at this in 3D. And again, you know, I was going to build up optionality within Poseidon so you can see, you know, to use it for spread trading. But again, you know, if you wanted to do this in Excel, you should be able to. I don't, because I'm more of a math kind of guy. But, I think I can take some questions. Sandra said, what are you looking for in the 3D model? What do you mean by that? Large deviation. Right, okay. What I'm looking for in the 3D is movement. So let's say I want to take a look at a larger time frame. You'll notice that this study here, the previous chart, didn't want to do it. Hold on. With all these all this graphic stuff that's going on with recording and doing the webinar, it slows the processor. Hold on, guys. Okay, here's a good example. All right, this is the full data set. So almost 14 years of data, no, not 14, maybe 13 years of data. So you can see here that it starts here, and you can see that plateau in the beginnings of the drop that we were seeing in the previous first chart. But over a 13-year period, you're seeing huge swings in the actual market, in the treasury market, all along the yield structure. And you can see during this time period is definitely the Lehman crisis, and then the intervention of the Federal Reserve and how we're at a very low, positively sloped structure. But even in this time frame here, you actually had quite a bit of movement in the 30-year here. So by spread trading, you can actually play on those movements, but it doesn't have to be spread trading. Spread trading would be maybe buy or short, buy or short the 30-year, and okay, Brian, thank you.
No problem.
The buy or short the 30 and do the opposite for the 30 day or the 1 month treasury. So, but the whole point here is to look at the cyclicalness of the treasury yield structure here, and understand certain dynamics. So if let's say you didn't want to trade the treasuries, maybe you're not a bond trader, not a future bond trader or anything like that. You could use this as an indicator or telemetry of the economy. So again, when it's in positively sloped yield structure, you have a good economy where interest rates are low, money is easy to obtain because the interest rates are so low. But when money demand starts to increase, when there's higher activity, economic activity, that might be outpacing the actual productivity of the society, then the interest rates will start to creep up. On top of maybe the central bank going in and trying to intervene and raise interest rates, what will happen is that you'll start seeing this movement in the front of the curve, like you have here. The front of the curve was starting to go up, and it started to have a flat yield structure. And remember what I said, it seems kind of odd that you could borrow money or you could loan money out for 30 years and have the same interest rate and roughly one that's at 30 days. And that's a perfect sign that there's some major issue with the economy. Things are out of equilibrium if you're using terminology in chaos theory, and that there's going to be some sort of correction. And you could use that as telemetry for shorting the market. You could use the changes in the yield structure could be I'll consider as an exogenous signal for shorting the market. So hopefully that kind of explains it. If someone has another question. Okay, I'm going to answer Goss. Hopefully I'm pronouncing it right. Question: did your model alert to the best trade to enter on a certain date for a spread trade? Well, right now the capability of Poseidon is to graph it. I show things in, and I don't have it in this webinar, but I do show things in terms of probability. So we could do a probability study on what's the probability of the yield structure in the front of the curve to be going up or down, and based on that, if it reaches a certain threshold point, that could be a trading signal. That's one way to do it. So yes, I mean, through probability, the model could alert for a trade if you want to do spread trading. Me personally, what I do is I look at yield structure relative to the 10-year and consider that as a risk signal. When people are risk averse, they'll start moving into the treasury market. So that's going to be affecting the yield structure, right? So when you see changes in the treasury market, a simple one would be just look at the 10-year treasury or the 5-year treasury and say, well, if people are fearful of the market, they're not going to be going into equities, they're going to be going into bonds. And they could go into bonds many different ways, but one way to see what's going on in the bond market is to look at the 5-year future or the 10-year treasury future. And if it's appreciating in terms of price, not in terms of yield, but if it's appreciating in terms of price, then that would mean that there is more risk aversion in the market. So that's one simple way to look at it. This is a little bit more in depth by looking at the change in the actual yield curve and viewing stress in the market. Just seeing one data point in the futures market and how it's changing along one particular treasury over time, I don't think gives the full picture of what's going on. You need to see the whole yield curve through time or a longitudinal study, and that's why surfaces, I think, help. So Sandra, is that okay? This chart okay, or do you need something else? Okay. And let me see if there's any other questions here. So hopefully I answered your question, Sandra. Anyone else have a question before I continue? Okay, so now the idea here is that you can zoom in on a certain area and say, oh, when I'm doing this study, I want to zoom on this area. Well, you could pull up, let's see here. The idea here would be that you would pull up different windows, surfaced windows, and look at the data a little bit closer, and rotate it around and take a look at it. Oh, okay, this is what's going on in that local area. And if I wanted to see a little more resolution on a 30-year, last 50 days or so, I could bring up another chart that was pull out Poseidon, and then you would see this. And if you wanted to see what was happening the last 50 days, so in the 30-year, you could look at this relative to whatever point that you would want on here. So that's kind of the graphical way of looking at it. I did not make PDF or CDF functions for these to give an idea, but I think that this was kind of a good primer to just explain to people how to use yield curves and yield surfaces for their particular trading. This is going to be kind of like a short lecture. This is not a real marathon lecture or anything, but before I go back to the PowerPoint, just talk about a little bit more development in Poseidon. Is there anyone that might have a question about what a yield curve is, or what a yield surface is, or how to read a yield surface? Or any other comments about the market? Oh, so you trade bond futures. What kind of bond futures? On the CME? Do you do spreads? Do you do spread trading between the yield, the different maturities, or do you just buy a future specific to a particular maturity? Okay. So the individuals that are online here, Goff is using U.S. and the boons. Do you do U.S. and boons as a spread, or do you do your spreads between boons? Okay, so it's between the U.S. and the boons. So the question I have is, the German yields are they higher? I'm not familiar with the boons. The German bonds, are they higher than the U.S. bonds right now? I think the yield differential is higher. It's a yes? Okay. So do you stick to a certain maturity, like the 10-year? Are you looking at like the 10-year boon and the 10-year U.S., or are you looking at a 5-year? What kind of maturity do you normally look at? You trade the curve. So you trade all different types. Yeah. Yeah. Have you been doing this for a long time, or? 30 years. Oh wow, you got a lot of experience in doing this. Can you speak at all, or no? Are you on a web viewer? I'm not sure if you can speak or
Can you hear me?
not. Yeah, I can hear you.
My name's Jeff, and I've been trading bonds for 30 years, and I trade a lot of bonds on futures markets around the world. And I love your idea of plotting out the actual surfaces. It's a great idea because, I watch the shape of the curves a lot, particularly between the US points on the curve, 2 5s, 10s, and 30s. And I also watch it in the bond market as well. And then I watch the bond market against the US market on the spread there. And then I also do, if I'm going to do it, I do in the sense of, what's the convexity as well. And, pretty much that's part of my my company that I do for my own family office here in California. And,
Cool.
that's awesome stuff.
Yeah, what's interesting is that a lot of people don't realize that the bond market is pretty dynamic. There's a lot that goes into it. I think it actually is more complicated to actually trade than an equity market. Or, my primary trading is in currency and in oil futures and natural gas futures, but the bond trading is a different beast.
Well, I truly believe that you need to. I also trade currencies as well, and if you understand the currency market, you understand the bond market. If you understand the bond market, you understand the crude market. And if you understand all those markets, you can easily understand the stock market.
Right. Oh, absolutely. I totally agree with you because, I have a lot of different screens, and you probably do too. And, people that have been in the business for a while, it's not just looking at that particular asset that they're trading. I call it telemetry. And, I have a lot of different telemetry points that I'm looking at. And that gives me some signals to have certain types of conviction on the actual assets that I do trade.
You should also do these surfaces on forward FX rates.
Right.
To see the variation of FX rates as well.
Right. I just, because of what's going on in Europe, because, Europe seems to be having a problem. What's your take on, because you're trading bonds, you're probably seeing yields going down because there's probably there's risk aversion. So probably the boom market is a safe haven in Europe.
Yeah, well, Europe's looking at probably doing some, they've employed BlackRock as an agent to basically take some of the asset backs out of the market, a bit like the Fed did. So I think Europe's still a bit of a basket case. I think US is quite strong, but I think there was some possible sort of slowdown second half that the bond market was pricing into. But if that doesn't emerge, then that's why stocks have been on a roar, right? But now stocks, I think, are popping out a bit around this level. And then bonds could react a little bit as well. So it's interesting.
Yeah, I remember reading something on Bloomberg. They were saying that the actual front of the curve for the German bond market is actually negative interest rates.
Yeah, the bonds have been up to zero grade. And basically there's no money in it. But you've got to keep a very close eye on the European markets if you're a bond trader. So I'd be interested if you do any stuff on this on the bond market.
Right. Do you have do you think that Europe is actually moving into a recession?
Yeah, it's acting a bit like Japan did. And I think Draghi is speaks like that. And he's going to take a lot of the suspect assets off the books of the banks, put them with BlackRock, a bit like the Fed did, right? And pump liquidity back into the banking sector. So there's shadows. I used to work in Japan for a long time, so I'm very much familiar with Japan. And the thing about it was there's a lot of things happening in Europe that mirror a lot of stuff that happened in Japan. And Draghi doesn't want that.
Right. Right. Let me, that's a good point that you're making here. And just for individuals that don't trade the bond market or not used to understanding the dynamics of this yield structure, what Jeff is talking about here is that as money demand increases, interest rates on the front of the curve start to increase. All right. or when when the central banks start raising rates. It also affects the yield structure on the front of the curve. Now, when there's a bunch of liquidity that's pumped into the market, because once this happens, once we get to here, there's usually a recession. And what happens is that the Federal Reserve has to come in and pump liquidity into the market. Now, how they do that, there's many different ways, but one way of doing it is actually going into the bond market and purchasing bonds and depositing cash into the federal banks. And what happens when they do that is that as they're buying those bonds, the yields on those bonds are starting to drop. And then there's money's created by doing that, and then hopefully, at least in monetary policy theory, is that it goes back to a normal yield structure, and then you get into somewhat of a steady state. But you could still be making money because you can see these undulations that are taking place with the different spreads between the different maturities. But you have to watch out for it. But when you look at these things in a larger study, like over a 50-year period, you'll notice that these things will cycle. These waves will cycle, and what will happen is that they're highly correlated to when there's recessions and when there's intervention in the banking market. But I just wanted to say that to the ones that are a little bit new to looking at these types of things. Jeff is been doing this for 30 years, so it comes natural to him. But I just wanted to explain that when the banks, the central banks, pump liquidity, what that really means is this dynamic going on here in the yield structure, and it's dropping. It's changing the structure of the yield curve. Okay, go ahead, Jeff.
Yeah, well, as I say, the Fed always comes in when there's fears and does repo, and that's how they pump the money in. But probably starting next year, they'll probably go reverse and unwind those repos and take it up. They're also doing terminal operations, which is called POMOs. We continue to do that at the moment at a lesser amount. And at the end of the day, you cannot go against, if you're anything to do with a trader or a portfolio manager, against knowing what the Fed is doing. So you doing this work on sort of 3D graphing is very important, right? As a product, because of the fact that understanding what the Fed is doing is the most important thing. But what I would suggest you look at over time is you look at things like high yield bonds relative to treasuries, and also those sort of things, because if we're rolling again into a crisis, the first thing will be affected first will be the high yield bonds, and secondly, will be flight to quality into treasuries again. And that's one of the good things to watch. You can do that by ETF, so you can do that by any measure.
Right. Well, that's a good idea. And this adds to that whole idea that there's telemetry in the market that may not necessarily be the asset that you trade, but if you watch the changing dynamics in the bond market relative to the sovereign bonds, to the actual corporate, the commercial paper, or the corporate bonds, and those changing dynamics will be signals, I think, to certain mean reversions that take place in the equity market.
Very much so, because then that's into the equity market, and typically bond guys know what's happening in those corporate bonds, right, the high yield ones, and they know that typically for the equity guys.
Right.
Okay.
And interesting that you say this, because the research study that I've been doing for my dissertation, I'm in the data collection mode right now, but I'm doing this dynamic hedging with currency and oil futures, and using the levy process to, I parameterize the levy process for the particular future curve time series, but I also look at the LIBOR changes, the structure of the LIBOR, and changes in LIBOR are what I call an exogenous signal to change my dynamic hedging time period. All right.
Yeah.
And what's interesting, what you're saying about the bond market, is that in the TED spread, so that's your overnight and the LIBOR rate, that spread will widen, and that's usually a signal that they're stressing the banking industry, and it's tied into these widening spreads that you're talking about with sovereigns relative to the corporates.
Correct. And if you don't,
There's a wave. It's almost like a earthquake tremor within the TED spread, and you're probably seeing it also in the looking at it in the bonds before even the traders in equity even know about it. The tremors usually 3 months or so it happens, and there's a lot of behind the scenes that are going on between the central bankers and their particular treasury institutions, where they're trying to go in and bail out weak banks, overnight bailouts that we never know about.
Yeah, Paul, I'll come first of all into do that bond trade. They'll do the 3-month overnight index swap against LIBOR. That's the TED spread. They'll also do it in Europe, which is the Ionia, but they'll also at the same time do the currency. The reason why is currency guys, when I was in banking and everything else and trading for a long, long time, we sat next to the FX guys. The FX guys wanted to know what was going on.
Right. So, are you thinking that because of what you're seeing in the boom market, do you think that the euro is going to break the 130 mark?
Yeah, well, I've been short the euro for I shorted it. Let me tell you where I shorted it here. Hang on a second, just put my system up. Give me just 1 second here. Basically, it would have been approximately. Check here. August 12th, August 13th. Right.
Mm-hmm.
That's when I heavily shorted the euro against the US dollar, and I'm still short.
Right.
At the moment. Right.
So you think that it will break the 130?
Yeah, it should go down and test it. It's sort of holding here at the moment, around 133. But I have an algo that does that, and that algo's been performing pretty well. Like, my algo runs at about a, 2.39 win loss ratio with an 80%, profitability. So it's one of my favorites. But I watch the euro a lot because, over time, Europe's allowed the US to fix their problems first, right? And now Draghi is going to get BlackRock to help, right? Now it's time for Europe to fix their problems, right? As the US comes out of this. So dollar's going to get stronger and euro's going to get weaker in that process.
Right. Exactly. Yeah, and I agree. I think that Europe is going to be having some problems. Now, how do you think that's going to spill over to the United Kingdom? Do you think that the UK is going to, I noticed that the pound relative to the USD dropped quite a bit. And the rumor is, and it's not a rumor, but the news is at least publishing that it's really because the BOE didn't raise rates like they thought they were going to do. But with the stress that's in Europe, do you think that is more of a cause for the pound to be going down?
It's got to do with the fact that Carney, right, which came from Canada, right, is
Right.
very much in the model, right? And he was really brought in with the Bank of England to be the spokesman for both probably the UK and a little bit of Europe with Draghi, right, to implement some of the more of the stuff the Fed had actually done, right? So sterling had a rally, but then it got the same treatment as the euro was falling, right? I thought the more bigger mover was going to be in the euro. That's why I shorted the euro, not sterling. But, I don't think it's over just yet.
Right. Now, because I trade these currencies, quite a bit. I just so happen to be the dumb one that was caught with the 1.71 on the pound, and I was longing. So I'm kind of riding the wave downward. Now, I personally think that it's gonna go and probably go to about 1.63, 1.64. I don't know where it closed today. I think it was at 1.65 last I looked, but I think that the pound is going to be relative to the USD is going to go down. I also believe that the euro is going to continue to fall past the 130 mark. I don't think it'll probably go to the 125 mark, but maybe it will. I'm not sure. Because the research that I have seen, the banks are more exposed to leverage. They're more exposed to shocks to the equity market in Europe than they are in the United States. So, who knows what the contagion happens when stuff really starts dropping in asset value in Europe. So anything could happen. But what I don't understand is I don't see the stress in the euro yen. It's been bouncing around, but there's not a lot of shock like you see in the euro USD. So I'm thinking what it is it's currency traders thinking, well, you know what it is, Yellen's going to be doing, pulling off on the gas, for QE, the whole, maybe accelerate the tapering or maybe even start really tightening. And, with Europe, falling, economically a little bit here, that it lends itself to strong USD and a weak euro, but not necessarily a weak euro relative to the
mainly for the fact this BlackRock thing taking the mortgage-backed securities and releasing funds for banks is the first sign of like the LTRO or the home loan the Fed's been doing, right? Mm-hmm. And Draghi's been working this out for quite some time and picked BlackRock to do it, right? Which is very good at managing those assets they did for the Fed, right? That only came out overnight, and that to me was a sign that hang on a minute, things in Europe aren't as rosy as what we thought it was, right?
Right. Well, I mean, Draghi was quoted as saying, I think a couple of days ago, that the peripheral nations need to start spending. That it almost seems like Draghi is becoming more of he's not as an austere type individual like the Germans. So, he's basically saying, hey guys, you can't have austerity you can't push austerity on the peripheral nations and assume that it's going to be all hunky-dory economically. So it seems as though Draghi is pivoting himself away from the typical German doctrine of austerity for all.
Yeah,
so I think,
if you do this on the bank, on these mortgage-backed securities held by the European banks, it'll bring down yields of the European banks, right? What you want to do, not bring down bond yields anymore. They're down as far as they will. But bring down Spanish. You've seen Italian bonds this week were at the lowest they've been for a long, long time, right? It's only bringing down Central Europe for helping out the banks, right? And that brings down interest rates right across Europe. And exactly what the Fed did, right, spurs over time, right, more investment and everything else. So.
Yeah. I mean, Soros, he just published a book. I forgot what the name, I read it. I can't remember the name of it. Turmoil in Europe or something like that.
Yeah.
And it's a book about him being interviewed. So it's kind of like a conversational piece. And it's 3 or 4 chapters long. And he talks about this normalization that has to take place in his mind. I'm not really sure if he was thinking normalization meant higher yields for the core nations, to get closer to the higher yields in the peripheral nations in Europe, or if it was the other way around, where it's the peripheral nations have to go
back
over
the German rates, bring them back a little bit towards neutral, and bring down the wings, as I call them, which is the outside markets. Mm-hmm. And I've seen Italian bonds rally dramatically over the last week and a half. I've seen Spanish bonds rally in the last week and a half. Right? They're all going well.
Yeah.
So it's having effects, basically.
Yeah. Yeah. Just for everyone else that's, maybe not trading the bond market specifically, like what Jeff's saying is that it's really the bond market that's moving things. And it's probably, what actually wags the dog. So, but it's very interesting. It's a specialty. Trading bonds is a specialty, and there's different ways to trade it because of all the complexity involved. But it gives individuals, I think, an understanding of the economy and what's really going on in the market. But it takes, I think, years to really become a master at it. And obviously, Jeff was, doing it for 30 years. He's developed those skill sets. Um, does anyone else have a question, maybe for Jeff or myself, um, about trading or relative to bonds or anything like that?
The only other thing I've got is due to volatility on these bonds as well, graph volatility.
Would you say that again, Jeff?
Do you graph the three-dimensional volatility like you do in the currency market? You do that also in the bonds market?
I haven't done it in Poseidon yet. I'm just starting to do that. I'm just starting to figure out how to use this yield surface. Now, so time in time. Let's say if you wanted to see a three-dimensional graph, all right, or a 4D, where it's moving in time. What three dimensions would you want to see?
3 dimensions. I'd like to see sort of the term structure of volatility for the bond market. That'd be interesting.
So, okay, so your Z is the volatility, and you're looking at you have maturities on your, let's say, your Y, and your X is going to be time. So each maturity has about, so what you're seeing is that the measurement of volatility is really the standard deviation of returns of that particular maturity within a certain window.
You do like some gauge analysis or something like that on volatility of the bond market, right? Across different terms. You can probably even use futures markets to do it.
Yeah. Now, I haven't done that, but it's a great idea, and I'm gonna definitely look into it. I think that because of the unique complexity of the bond market, it lends itself to some interesting analysis in 3D. I'll have to work on that. I haven't really investigated. This is most of my investigations with volatility surfaces are more in the currency, the oil futures, and the equity market, not the bond market. But I don't see why it can't be.
I think bonds should start it really, and certainly do foreign exchange. That's important, and less so as you get into the equity market.
Right.
Because really, at the end of the day, the world starts when you start up a country, right? First thing they get is currency. Second thing they get is forwards. Third thing is they get bond markets. Fourth thing they get corporates. Fifth they get convertibles. Sixth thing is they get equities. Right? Just way down the screen, right? So it's most important is the FX market and the bond market, the two most, and then crude, of course, right? Then it's the equity market.
Yeah. No, I'm gonna have to develop that, and I'll share that with you. You can as I was saying before, you can go to my let's see here. Jeff, if you could either follow me on Twitter or YouTube, subscribe, or just an email, through this website here. You can send me an email through the-studio-trakovic.com. This is my company. I'd like to talk with you further about creating some surfaces specifically to your needs, because you have a lot of knowledge about the bond market that may be very beneficial in developing a specific surface or surface strategies that you could use. Yeah, no, I appreciate it. So, okay, so just going forward, we've been on for almost an hour or so. So just to wrap up here, the whole point here is that you can see the bond market over time, and that there is movement in the market, in the bond market, along its whole yield structure, and it lends itself to understanding trading opportunities. But not just that, as Jeff was saying, you can understand the global economy by the movement of these curves relative to other bonds in different countries, or the different company commercial paper, or their bonds, and how the yields are changing. So there's many ways to use these types of graphs. Again, this lecture is more of an introductory lecture into just yield surfacing. Now, just to explain a little bit of what I'm doing with Poseidon, I'm going to do a production release. I've been doing a lot of beta testing. I'm hoping to have this thing ready for people to use in production in late this year. And basically, what I'm going to have are these particular options. There's going to be 2D graphing capability, 3D graphing, which is really the core of what Poseidon does. It's going to create these probability distribution functions and cumulative distribution functions. There's going to be part of my dissertation, some of the technology that is in my dissertation in terms of receding horizontal control and stochastic programming for dynamic hedging. I'm going to have some of this in Poseidon for individuals that want to use that as a dynamic hedge method. Other hedging methods that Poseidon will have are the standard delta hedging based on the Black-Scholes model. A stronger standard hedging method that augments the Black-Scholes model is the Leland map method, which is actually adding transaction costs within the model through volatility, and the Wiley and Wilmot model, which is a threshold model for dynamic hedging. Then Poseidon will be able to produce these trading signals, and these trading signals could be read by another system as a buy-sell signal, or maybe a strength of the buy-sell signal, and put into another algorithmic trading platform to trade. So it can be somewhat linked, by reading the data that's coming out of Poseidon. And it's going to be also able to calculate the correlations of assets. So if you have a portfolio of many different assets, then you'll understand through the correlations how volatility could affect those correlations. Correlations break down, especially in volatile times. And then obviously, the core of Poseidon is the 3-dimensional, 4-dimensional graphing capability. So what I'm going to be doing is have this volatility prediction analysis. Now, volatility is a hard animal to tame. So, I'll try my best to try to tame it. And then this yield structure analysis. And Jeff has said some really neat things that have created some good thoughts on how to develop that yield structure analysis, not just with the U.S. Treasury market, which is, I was maybe a little bit too centric on the U.S. Treasury market, but actually looking at spreads between different countries and how that could be used as indicators for trading, or even for exogenous risk for equity or currency traders. So that's some of the concepts and capabilities that I hope to have in the production release for Poseidon. And then people that have been listening to some of my lectures and some of the stuff that I've been publishing on YouTube, I'm developing Poseidon to be not just a normal desktop, laptop kind of application, but actually have it ported into a VR world using Unity 3D. And the idea here, and there is some technical hurdles that I have to overcome to do this, but the idea is basically to have these surfaces that you've been seeing in many of the lectures I've been doing, and have it ported into a VR world and see many of these different charts. People like Jeff and myself who have lots of screens on their desk, it's very hard to see all the charts that you really want to see or all the telemetry you want to see patterns that's going on. In a VR world is perfect for that. It's endless space in a virtual world, and you can roam around with all this different telemetry, and the idea is to have a better sense of all this data. So it's kind of almost like data mining the market telemetry within a VR world. So that's some research that I've been playing around with, and hope to bring that to market in a future release of Poseidon. So that's what I've been doing, and what how I see a little bit of the future of this topographical finance research and development. If anyone has some questions before we part, I'm glad to try to answer them.
No, that sounds good, Chris.
Okay, so let's see here. Thanks for showing, Sandra. Very important to understand. Jeff is, saying that it's important to understand the swap curves and the bonds, and that that this could impact the term structure. And I think that's very important to integrate that into this yield structure analysis functionality. So if anyone has any other questions, I'll answer them. If not, then we can close it up here.
I think it's good point. It just says keep an eye on the swap curves. The swap curves drive a lot of stuff in bond curves, and it's one thing that a lot of people, external to the bond market, don't really focus on. Okay.
Right. No, totally agree. And I think it's some of the ideas that you have are really good. Okay, I think that will be it for tonight. And what I'm going to do is I've been recording this, so I'm going to post this on my YouTube website, and also give a link to Brian, and you can post it in Quant Labs, and so people can review this at their leisure if they want to. But thank you very much, Jeff, for your insight, and I hope to be collaborating with you and developing some services that you could use for your trading, and how to develop the site. Okay, so I guess that will be the lecture, and we can end. Thank you very much for coming out. Appreciate it. Thank you, Jeff.
Thank you.
Okay. All right, good night, everybody.